Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
A fine is a tax for doing wrong. A tax is a fine for doing well. Tact, the ability to tell someone to go to hell in such a way that they look forward to the trip. Meetings are indispensable when you don't want to do anything. Inflation is taxation without legislation. A fanatic is one who can't change his mind and won't change the subject.
This chart shows crude had its war-driven adrenaline rush and then went absolutely nowhere. 5 years on, oil is back near early 2021 levels, even after sanctions, conflicts and shipping scares. A strong dollar capped upside, demand growth softened, and the energy transition quietly did its work. Geopolitics still spikes prices, but structure pulls them back down. Oil hasn't died, it's just lost its monopoly and fear. This chart shows that policy noise did not break the flow. Despite punitive tariffs, US-India goods trade is up 16% year-on-year, and that's not just a one-month sugar high. Imports from India are holding a steady $7.5 billion a month, while US exports are quietly up 10%. The message is simple. Supply chains adapt faster than press releases. When demand is real and diversification is strategic, trade finds a way, even through tariffs. As Milton Friedman said, one of the greatest mistakes is to judge policies by their intentions rather than by their results. This line finally bends the right way. Bank credit growth is back near 15% after 2 years of underwhelming expansion, and that matters more than any single GDP print. Credit is a transmission mechanism. Without it, capex stories stay theoretical. This rebound suggests balance sheets are healthier, risk appetite is returning, and banks are lending beyond just retail comfort zone. It's not a boom, but it is indeed ignition. This chart flips the mental model. Non-profits aren't just grand makers anymore, they're major financial players. Over $13 trillion in assets spans real estate, equities, and credit, making them systemically relevant allocators of capital. Endowments, foundations, and institutions now move markets the way mid-sized sovereign funds used to do. And because their horizons are long and tax advantaged, they can ride cycles most investors can't. Philanthropy did not abandon finance, it mastered it quietly. This chart explains why the US economy feels strong and fragile at the same time. Nearly half of all consumer spending now comes from the top 10%, turning growth into a high-income balancing act. When asset prices rise, consumption hums. When markets wobble, the engine curves. The bottom 80% matters politically, but economically they have lost share. This is not a broad-based demand story anymore. It's a wealth effect economy with very narrow shock absorbers. This chart explains why every global car maker watches Beijing more than Detroit. 1 in 3 cars sold worldwide now sells in China, meaning pricing power, EV adoption and margin pressure are set there first. The US remains profitable, India is a growth option, but China is the volume engine that decides winners and losers. If you're not competitive in China, you're not global, you're regional with ambitions. This chart says markets delivered, but not where everyone expected. Equities did well across the board, yet US dominance clearly faded as Europe, emerging markets, banks, and commodities stole the spotlight. Silver went full rockstar, while Bitcoin reminded everyone that it still enjoys dramatic entrances. The real story isn't strong returns, it's rotation. Leadership broadened, correlations loosened, and global diversification finally earned its keep. Exceptional markets, yes. Singular US exceptionalism, less so.